Swing trading versus writing covered calls. Which one is best? Well, in my opinion, covered calls is better than swing trading, and here's why. First of all, swing trading is when you buy a stock lower and sell it a little bit higher to make a capital gain. Usually it's in a short-term period, weeks or months. But the problem I have with swing trading is sometimes you'll think a stock is a good price, you buy it, and then you're stuck holding on to it for a while because either it's moving horizontally or it continues to go lower. And when it continues to go lower, all you could do is probably buy more stock so that you have a lower cost average. And then when eventually it goes higher, then you could sell and make whatever return you were going for. For example, now I've had some success with swing trading, but I've also had some really bad trades with swing trading. For example, I bought Kraft Heinz at 75. Back then, I think it was trading in the high 90s. So when it dropped to 75, I'm like, okay, seems like a good price, relatively low compared to what it was normally trading at. And also the fact that it's on Warren Buffett's portfolio, so that all these reasons gave me confidence to buy it at 75. And it was paying pretty good dividends, 4% per year about. But then of course what happened is that it kept dropping slowly and slowly in the 60s and then in the 50s, and then it made a run back up to the 60s, and then recently in the 30s. So now I bought a stock at 75, it's trading in the 30s now. So a stock that I was confident buying it. What can I do? All I'm getting right now is getting dividends from it. I'm definitely going to have to wait a very long time before it goes back up. So because this scenario could occur often, I don't like swing trading anymore. It used to be my strategy, but I don't like it anymore because of that reason. And it's happened to me before with GE. Bought it at 17 and it went all the way down to $6. Now it rallied quite a bit right now, but it's still going to be a while before it reaches 17. HBC, same thing happened to me with HBC. Bought it at 13.5 and I think right now it's around $8, a little bit less than $8, but it's definitely been over 2 years that I'm holding this stock. Now, it's great that I don't put everything in one stock, so I diversify so in case this happens, but because you can't control how many times this happens, and there's got to be a better way. And the way that I've discovered is writing covered calls. The beauty of writing covered calls is in that same scenario, in that Kraft Heinz scenario, let's say I bought it at 75, I would have immediately wrote a covered call on it. So I would have sold a call option against it, let's say at the same strike price of 75. Could have collected about maybe, let's say 2 or 3% in 1 month. Now, Kraft Heinz would have dropped. Since I would have sold a call option at the money for Kraft Heinz at 75, so I'm going to end up keeping my shares at 75 and I already collected a premium. So if you compare writing covered calls versus swing trading, in one scenario, I bought the stock at 75, but the stock drops. In this second scenario, I bought the stock at 75, the stock drops, but I got something out of it. I collected a premium of 3% for the first month. So then the next month I see the stock is trading at 70. I still own the shares, my call option expired. So I have the option, I could sell another call option at 75 again. The stock is trading at 70, I could sell another call option at 75. I won't be collecting 3% this time, but I could probably collect 1%. So in the swing trading scenario, the stock is at 70. I bought the stock at 75, it's at 70. It's been 2 months now. I'm down quite a bit. Didn't gain anything from holding the stock except maybe dividends. In the second scenario, I bought the stock at 75, it's down to 70. First month I collected 3%, second month I collected 1%, and also the dividends apply as well in this scenario. So as you can see already, there's a stronger advantage to writing covered calls than to just swing trade. And then the third month, the stock continues to drop. It's trading in the 60s. So in the swing trading scenario, I've got a stock that's trading in the 60s, but I bought at 75. In the covered call scenario, I got a stock that I bought at 75. It's trading in the 60s. But in the first month, I collected 3%. In the second month, I collected 1%. Now in the third month, for sure, I cannot sell a call option at 75 because the premiums are going to be very low because the market price is way far from 75. So I'll probably have to take a strike price that's closer to 60. But the risk is because an option has an expiry date, if the market price is trading above the strike price that I choose come expiry date, my shares will get sold at that strike price. So if I bought the stock at 75, I don't want to sell my stock at 70, but I have to choose a strike price that's closer to 60 in order to collect some decent premiums. So I bought the stock at 75, it's trading at 60, and it's the third month. I want to get something out of it, so I'll have to choose, let's say, a strike price at around 70, maybe 67, 68. probability wise, I probably have a high chance that the stock that's trading at 60 currently is not going to be trading at above 68 or 70 come 30 days. So because that's the case, that's most likely the case, I would have sold another call option at around 68, collected maybe 1% or 2%. So in this case, I'm lucky because the stock is continuing to drop. So I continue to keep my shares. And then the stock drops to the 50s. So now I bought, in the first swing trading scenario, I bought a stock at 75. Now it's worth 50. In the covered call scenario, I bought a stock at 75. It's worth 50. But the first month I collected 3%, second month 1%, third month 1% with a bit of risk that I could lose my shares at 68. But I got lucky. Odds were on my side. Now the stock's trading at 50. I'm going to sell another call option. Obviously, I can't sell at 75. I can't sell at 68 either. I'm going to have to get closer to 50. So I'm going to have to pick maybe 60, 58 maybe. I have to pick a strike price that I'm confident that the market price will not be trading above that strike price come 30 days. So I just keep doing that month after month, collecting whatever I can collect as long as I don't lose my shares at a lower price than what I bought it at. So basically, I'm turning a losing trade into an income generating machine. Obviously, if the market price is closer to your cost, then the returns that you'll be getting per month will be higher. But in this case, I'm saving a stock that's completely drowning. And what's great is I can buy more shares at $50. So my initial cost was 75, and I can buy some more at 50, making my new cost, let's say $62. So then I can comfortably sell at a strike price of 62 without being worried that my shares get called at 62. If they do, that's not a problem. It's my cost anyways. My returns will be the 3%, the 1%, the 2%, the 1% per month that I'm making, plus any dividend I would have collected throughout that period. So that's really why I find writing covered calls better than swing trading, because a stock can only go three directions. It could either go up, move horizontally, or go down. So in the case of a stock going up, covered calls might not be the best strategy, because the main disadvantage of writing covered calls is the strike price that you choose is the price at which you're going to sell your stock at. So you're going to miss out on potential upside when you write covered calls. So if you buy a stock at 70 and you sell a call option at 70, you're going to collect that premium of 3% or 5%, but then the stock moves to 80. So you can't sell it at 80. You missed out on that. You got your 5%, but in the swing trading scenario, you would have made more, maybe 12%. But how often does that happen? So if you compare all three scenarios and their probabilities of happening, if you stick to the small, consistent gains through a long period, you're going to end up on top, because a stock going from 70 to 80 does not happen more than a stock moving horizontally, a stock dropping. In the scenario of a stock moving horizontally, with covered calls, you still collected that 5% or that 3%, while in your swing trading scenario, you got nothing. If a stock goes down, you still collected your 5%, while in a swing trading position, your stock is down. So because the covered call strategy allows you to be profitable in three different scenarios, two of these scenarios happening more often than one, in the long term, it ends up being a better strategy. Plus, what I like about it is that every month I get something, I get a return. Swing trading, I could wait 2 or 3 months or 6 months before I can get my return, even if it's potentially higher, but I have to wait. In a covered call strategy, I don't have to wait. I get something every month, sometimes 1%, sometimes 3%, sometimes 5%. But I still have to choose quality stocks, because at the end of the day, I'm owning the stock, the underlying stock. So I still have to buy a stock that I'm comfortable owning, and at a price I'm comfortable owning as well. But every day there's new opportunities. And there's a bunch of research that's been made that over the long term, covered calls is a better strategy, will generate a better return over time. I think Tasty Trade has made these types of research, but without even looking at these research, it makes sense. Just by trying it out, I can see the difference. Small, consistent, likely gains versus hitting a home run that's unlikely to happen or does not happen that often, or odds are not on your side. And some people actually, if you like the buy and hold strategy, you can also apply covered calls on that. You can also apply the covered call strategy on a buy and hold strategy to increase your dividends, to increase your yields. For example, you bought a stock at $100 and you want to keep it for life. You don't want to ever sell it. So the risk of writing covered calls is that you might have to sell your stock. So if you don't want to sell your stock, you can always write covered calls that are out of the money, far out of the money. So if you buy a stock at 100, you could sell a call option at a 115 strike price in 30 days, knowing that odds are on your side that the stock will not go above 115 come 30 days. Obviously depending on the stock and the volatility of the stock, but in most cases a stock will not jump 15 points in 30 days or 15% in 30 days. So if you're confident of that, you could sell a call option out of the money. You're definitely going to collect a small premium, maybe 0.5% depending on the stock. But if you could do 0.5% every month, that's 6% per year. If your strategy is buy and hold, well, you're probably buying a stock that pays 4% dividends. Imagine adding another 6% on top of that just by selling covered calls that are far out of the money. And let's say worst case scenario, which will not happen often. Let's say you buy a stock at 100, you sell a call option at a 115 strike price, and the stock does move up to 115.01. You collected your premium. If you wanted to really keep your shares, well, two things can happen. If a stock goes up to 115, your shares will get sold at 115, but guess what? You made $15 on $100 plus the premiums that you collected. But let's say you really want to keep the shares, you want to keep it long term, you don't want to buy and sell, you can actually just buy back the option that you sold initially. And because you're at a 115, because you're far out of the money, it's probably not going to cost you much to buy back. You collected maybe, let's say, 10 cents, you'll probably have to buy it back at 2 cents. Really depend. Even if you have to buy it back at 10 cents, so no gain, but it's not going to happen every month. You're gonna have more winning months than losing months. So really, that's what's beautiful about covered calls is it's a winning strategy in almost every scenario if you pick the right stocks, of course. And even if your timing is bad, it helps you with bad timing because you could sell out of the money, you could sell in the money. So if you buy a stock at 70 and you think it's going to go down, you could sell a call option at 70, or you could sell it at 68. You're ready to let go of your shares at 68, but the call premium that you collected is going to be more than the difference of 70 and 68. You're probably going to collect $4, for example, depending on the stock, of course. That's why it's great, because it works almost in every scenario. That's why I prefer it. In my opinion, covered calls is better than swing trading and better than dividend investing as well. The only advantage really dividend investing has is that it's really passive. It's the most passive way of making income because you just buy the stock and you just collect the dividends and you don't have to do anything else. It's really, really passive. Covered calls, of course, is not passive. It's much more time consuming, much more active. If trading on the stock market is something fun for you, then it's not gonna feel like it's time consuming. But if you compare really dividend investing to covered calls, you buy a stock at $30. You buy a stock at $30, and then 15 years later, it's still at $30 because it went up and down, and it's still trading at $30. Yes, you got your 4% every year, but if you compare it to covered call and you made 1 or 2% every month from that investment, you will be better off after 15 years. So yeah, that's my opinion on swing trading versus covered calls. Leave your comments below. Like always, if you're gonna open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. And it is tax season. If you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. So if you like this video, click the like button, share with your friends, and subscribe to the channel. And I'm starting a WhatsApp group where I'm gonna share my trades live. So if that's something that interests you, check out the links below. Thanks for watching.